inflation to exceed all-time high of 19.75%, and a 70% bond market crash. And David Brady tweeted this out: inflation is going to a new all-time high, which will exceed the previous high in 1917, which was 19.75%. That means a new high in interest rates and a total disaster for bond prices. Bond prices will fall 70%. Bert Dohmen. So why don't we just cut to a clip from that interview that he's talking about with Robert Kiyosaki and Bert Dohmen.
Right, and that's why, I was, you and I were living in Hawaii at that time, and you were famous and infamous. People talked about what you said. And they said, Dohmen's crazy. Why is he saying this and all that stuff? And I was just starting out. I just turned 30, I think. I had no money, and I said, what does this mean to me? When you're trying to put a real estate deal together, 20% interest, it's kind of hard to make it cash flow. Do you know what I mean? It was really tough times, but there were good times. The other thing I want to say is that when I meet so-called financial experts today, most of them don't even remember 2008.
Exactly.
They're so young. All they know is a bull market.
Yeah. All
they know is that interest rates kept dropping, bond rates kept dropping, the price of stocks went up, real estate went up, everything was going up. We call it the everything bubble. And that's why I highly recommend this. There's only one newsletter, is the Wellington Report, because at least you'll have an idea of what's going on underneath the blankets. And so be careful of the age of the person you take advice from, too.
Oh, that is such an important point. I wrote in the last issue of the Wellington Letter, 3 things you want to look for in your advisor. And if he doesn't have all 3, find somebody else that does. The first thing is the experience. I said, at least 44 years of experience in the markets. That gets you back to 1978. Right. You have to remember 1978 to 1981, because that is going to be replicated. I said, we're going to see the same thing. In 1978, we said, Treasury bond prices will decline by 40 to 50%. Again, that was called absurd. And it happened. They went down 44%. At this time around, I said, the inflation is going to exceed the level that we had in 1980. Okay, 1980 inflation was just hit. There was a 40-year high in inflation we have now. And we said, the next target for inflation is going to be a new all-time high inflation, which would exceed the inflation level of 1917, which was 19.75%. So we're going to hit a new high in inflation. That means a new high in interest rates. That means a total disaster for bond prices. Bond prices are going to go down 70%.
I'm going to look confused here. So are you saying that we're in 2022 right now? Are you calling for inflation to go higher?
Yes.
And then how does that destroy bonds?
Because when interest rates rise, the bond prices decline proportionally.
Right. So, a bond is this. Let's say if a bond that's paying 10% is worth so much money. But if the interest rates, if inflation goes to 20%, the value of the bond drops. And what most people do not realize, the bond market is 1 million times bigger than the stock market.
Exactly. It's much bigger.
And so that's why I listen to Bert all the time, because, those is beyond my little meager brain. The point here is back when Bert and I were just starting out, there were exciting times. Are you saying it's going to get more exciting in 2022 and 23?
Yes, we have a special report, in fact, Bob, that we're offering people for free, because this is imperative that people know about this, that they don't believe all this stuff that you see and hear in the media.
Right.
The big thing now is inflation. And that basically kills the bond market. Do you have any idea how much T-bonds are down already? This is a number that you don't even hear on TV. The T-bonds are down 36% from last year's high. 36%. This is a disaster, because all the institutions, pension funds, so on, they're loaded up to the gills in treasury bonds.
I understand. And that's what I'm saying is how old was the advisor?
Yeah.
You know what I mean? Most advisors today, all they
were
know
probably
is good
little
times.
babies in 1978.
Right. But this is the other part about it is so many of these idiots out there, you know, there's no cure for stupidity, as you know, Bert. We've seen a lot of it over our times. But I have the 60-40 mix. What is it? Means they have 40% this and 60% bonds, and they're operating by these formulas that worked right after 2008. This ain't 2008.
Exactly. The world changes and they pretend it is static. I mean, how can you have a constant ratio of 60-40? That's absolutely ridiculous. You want to have a methodology that gets you out during a bear market. So if you don't see all of the signals that we see, doing this 12 hours a day, then at least you should have a simple, like a moving average. And so if it breaks through this, we're out.
And the real bond king, Jeff Gundlach, whenever a new bill is proposed in Washington, it's labelled suggesting an outcome exactly the opposite of the one that would in fact be realised. Up next, Inflation Reduction Act of 2022. And Dr. Patrick Newman, who's an Austrian economist, said financial markets are still betting that inflation is transitory. They assume a temporary rise in the interest rate to only 3.25% will cure rising prices. They're in for a rude awakening. And speaking of awesome economists, let's just have a look at a clip from Milton Friedman on inflation.
Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first, and the good effects only come later. That's why it's so hard to persist with the cure. Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first, and the good effects only come later. That's why it's so hard to persist with the cure.
And coming in from the Daily Mail in the UK, inflation may hit 15% as Bank of England hints higher interest rates. And Roger Brown asks, Australia next? Well, if you have a look at the Australia Melbourne Institute inflation gauge month on month, well, we've had the highest ever reading. And that's almost 20 years of data and that's come in at 1.2% month on month. Now, feel free to annualize that. By the way, the forecast was 0.4%, so 1.2%. There we go. And coming in from Forex Live, the Australian Treasurer, Jim Chalmers, says inflation expected to peak in the fourth quarter of 2022 at 7.75%, which is much higher than what the RBA had forecast. I loved this tweet that my buddy Tarek shared because this is something I've been banging on about for a long time, where I have argued that between 1800 and basically when the Fed was created, if you actually have a look at wages, they tripled at the same time that living expenses halved. So I say to people, imagine if you were on $100,000 a year and your expenses were $100,000 a year. Well, 100 years later, your income, now I know you're not going to be around, but for your industry, your job, your income's now $300,000, but your expenses are $50,000 because things have gotten so much cheaper that you actually increase your purchasing power. And that's what a free market with sound economics is like. Savers get rewarded, producers get rewarded, sound investors get rewarded, where, well, since the Fed was created, the purchasing power of our savings just gets eroded. And this is why people have to take on risk to increase their savings, increase their earnings above inflation. And from Business Insider, Mark Sptiznagel says we should expect inflation to be elevated forever. The hedge fund chief calls the Fed's bluff on raising rates enough to tame it and told us how he thinks investors should really approach risk mitigation. He says the stock market could crash and the Federal Reserve won't have any tools left to stop it, including interest rates. So, who is Mark Sptiznagel? Last month I did this video, Investor Returns 4,000% using Austrian economics. And this video was all about Mark Sptiznagel. And it's actually true, he did return 4,000% using similar strategies in March 2020 when we shorted the market and made 780% return ourselves. And look, this is one of my favorite videos that I've done. Highly educational, in my opinion. And I think, if you guys want to understand how I invest, my philosophy behind investing, then definitely watch this video, and I'll put a link in the description below. So, inflation is a problem. It's high. Many are saying it's going higher. I argue that we're an inflationary decade ahead. And one of my firm beliefs in that is simply because of our energy policy. Energy is the bedrock of an economy. It's the heartbeat of an economy. And we have politicians right across the Western world and other bureaucratic institutions that, whether it's a Malthusian obsession, whether it's some people talk, well, it's a fascist or it's communist or whatever you want, they have decided that the society that we have built on cheap, abundant energy is no longer. And so, in my opinion, we're going to see an inflationary decade ahead solely because of that reason, because of the input costs into the rest of the economy is going to be substantially higher. And so, I do see stagflation happening because economically we have scarred the economy once again by government policies. I won't go into that on this video, but due to government policies, we've scarred the economy. And so, technically, in the US, we're in a recession. Globally, I think we will see that recession. Globally, I do see a liquidity event. And, even the deflationists see what the end game is. And, but they're positioned for this trade that's going to happen. And although I've shared on this video, this channel about the dollar milkshake theory, why I hold a percentage of my portfolio in US dollars, that is to play that out. However, I am also positioned for that end game. And, so the question really is that everyone knows inflation's a problem, that it's going to remain elevated. Mark Sptiznagel says forever. The question is, where do interest rates go? Where do central banks go? Some argue that we're going to see positive real rates. Some argue that we'll see 9% interest rates. I've argued that if that is the case, then we will go into a depression. The debt bubble will collapse. Others, like Mark Sptiznagel, are calling out central banks that they will not raise rates to effectively squash inflation. But if they can get the CPI number down to 5 or 6%, and I wouldn't be surprised if they start readjusting how they measure CPI so that they can measure it lower and report a lower figure and say, look, we've done something about inflation. Look, we're just going to have to get used to that 2% or 2 to 3% bandwagon, or that band is now 4 to 5% or 4 to 6%, and that's what we got to get used to. Negative real rates. That's something that's going to be a real issue moving forward. So no one's, well, other than a few crazy deflationists, but no one is really debating that we've got inflation and that inflation is a problem. People who do think that the central banks are going to raise rates into positive territory believe then we'll have deflation. And I agree. If they do, we are going into a depression. We're not just going to have some deflationary recession. We're going to go into depression because the everything bubble, the debt bubble, is going to explode. But others like Mark Sptiznagel says, no. We're calling the Fed's bluff. We're calling central banks bluff. And many central banks around the world have shown their true colors by, well, skimping on their inflation job. So the next thing is, well, how do we invest for an inflationary period? If we are going into a stagflation or possibly even a hyperinflation, how do we invest for that? Well, next week I've got a video that I'm working on exactly that answers that. How to invest in an inflationary environment, both stagflationary and hyperinflationary. Now, you all might think that my answer is simply invest in gold and silver or gold and silver mining stocks. Not quite. That's part of it. But next week's video, I'm really looking forward to sharing it with you and sharing a little bit more about how I'm investing, because I do see an inflationary decade ahead. And there's some very, very wise investors who, in this video I'm working on, is going to share a lot of wise investment knowledge. So I think it's going to be a very, very good educational video. I think it's going to be very valuable and one that I highly recommend you guys watch. So, yep, inflation's a problem. In my opinion, we're going to see an inflationary decade ahead. The question is, how do we position for it? And keep an eye on central banks. Do they raise rate to the point where they blow the debt bubble? Is that what they want? That we all, lose assets? Those of us that have debt, those of us that don't, or do they pause? Do they wimp out? And do they reverse? And at what point then do all fiat currencies start to collapse? Anyway, love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it, guys. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.